Welcome to our deep dive. We're cracking open the psychology of money today. It's all about why understanding people, like their behavior and stuff, is way more important than just crunching numbers when it comes to building wealth.
Yeah, that's a great way to put it. We often approach finance like it's this purely logical game, right?
Hmm.
But the reality is our emotions, our biases, all those personal experiences we have, they play a huge role in how we handle money.
Exactly. And this book, it like dives deep into those things, the stuff we often ignore, like how our childhood when we were born, even like random events, can shape how we view money and finances.
It's true. Like one of the first things the book says is no one's crazy.
Right. What does that even mean?
Well, think about it like this. A financial decision that seems totally irrational to one person might make perfect sense to someone else, based on their background.
Okay, I see what you mean. So it's all about understanding those individual perspectives.
Right. And sometimes those perspectives are shaped by factors beyond our control. The book really emphasizes that luck and risk play a huge role.
Yeah, like even for someone like Bill Gates, right?
Exactly. He was brilliant, driven, all of that. But he also went to this unique high school that had one of the only computers around back then. That lucky break gave him a head start that most people just didn't have.
So even with all the talent in the world, luck still matters.
Absolutely. And that kind of leads us to another big idea in the book: never bet everything. It's about building in a safety net.
Like those blackjack card counters.
Exactly. Even when the odds are in their favor, they never bet at all because they know one bad hand can wipe them out.
So it's about managing risk and having a cushion, right?
Yeah, it's like having a financial airbag for those inevitable bumps in the road, diversifying your investments, having an emergency fund, that kind of stuff.
Okay, so we're talking about being prepared for the unexpected. What about the long game?
Well, that's where the book highlights long-term wins. It's about how patience and steady investing over time can create serious wealth.
Like Warren Buffett style.
Exactly. He's not known for risky bets, he's just been consistently good for decades. Proof that slow and steady often wins the race.
Makes sense, but our brains don't always cooperate, do they? The book talks about how pessimism is seductive.
You got it. Our brains are wired to focus on the negative. It's like built in for survival and all. But this can make us way too cautious with our money.
Like we miss opportunities because we're fixated on what could go wrong.
Exactly. Think about the 2008 crisis. Felt like the world was ending. But looking back, you see how innovation and resilience pushed us forward.
So it's like, don't let fear hold you back.
Pretty much. And that connects to what the book says about happiness and control. The real value of money is the freedom it gives you.
Okay, I like that. So it's not just about being rich. It's about having choices.
Right. Even a little bit of wealth can give you more control over your time, your choices, which, often leads to greater happiness.
So it's about aligning your money with what you actually value.
Exactly. It's not about keeping up with the Joneses. It's about building a foundation that gives you options and peace of mind.
That makes sense. So we've seen how our psychology can really shape our money decisions. But what about investing? How do we approach that?
Well, the book dives into that too. It argues that it's more important to be reasonable than to be rational.
Wait, what's the difference?
Okay, so rational means always making decisions based on pure logic. But we're human, we have emotions. Being reasonable means accepting that, sometimes our feelings and biases will influence our choices, and that's okay.
So it's about finding an approach that works for you, your personality, your goals, not trying to be like this perfect robot.
Exactly. It's about finding a strategy that you can stick with that helps you sleep well at night.
Right, because we're not all cut out to be Wall Street wolves.
Exactly. And the book uses a fascinating example to illustrate this. It compares investing to the historical view of fever.
Fever? What do you mean?
For centuries, fever was seen as the enemy, something to suppress at all costs. But now we know that fever is often the body's way of fighting off infection.
So sometimes a little bit of fever is a good thing.
Exactly. And similarly, trying to eliminate all risk in investing can actually hurt your returns in the long run. You need a little fever to grow.
I never thought about it that way. That's interesting.
The book is full of these kinds of thought-provoking ideas. It really challenges how we think about money.
Okay, so we've talked about risk, but what about finding the right investments?
Well, the book argues that there's no one right way to invest. Everyone has different goals, different risk tolerances.
Right, so what might seem like a crazy valuation to one person could make perfect sense to someone else.
Exactly. It's about finding a strategy that aligns with your individual circumstances and goals. Don't just follow the crowd.
Do your own research, basically.
Yeah, and be wary of relying too much on historical data.
What do you mean?
Well, the world is constantly changing. What worked in the past might not work in the future. Even data from a few decades ago might not be relevant to today's market.
So it's about being adaptable and open to new information.
Precisely. The book really emphasizes the need for flexibility and a willingness to learn and adjust as you go.
Okay, so no magic formulas, just constant learning and adaptation. But what about those moments when the market goes haywire?
That's where the book brings in some fascinating insights from, get this, Las Vegas casinos.
Casinos. Okay, now I'm really curious.
Yeah, it uses the example of blackjack card counters to emphasize the concept of room for error.
Okay, so card counting gives players an edge, right?
Right, but even the best card counters know they can't win every hand. There's always a chance they'll be wrong.
So they never bet everything on a single hand.
Exactly. They build in a margin of safety to protect themselves. And that's the same principle we should apply to investing. No investment is foolproof.
We need to build in that room for error just in case things go south.
Right. Having a cushion to absorb potential losses and the ability to stay in the game even when the market takes a hit.
So how do we do that? How do we build in that room for error in our portfolios?
The book suggests a few strategies: maintaining a cash reserve, diversifying your investments, and avoiding excessive leverage.
Basically, having a buffer to weather those unexpected financial storms.
Exactly. It's about being prepared, not just financially, but also mentally, for those unexpected events.
Okay, so plan for the unexpected, but also be mentally prepared to adapt. Sounds like a solid approach.
Mm.
Now, the book also dives into something I find really intriguing, how the stories we tell ourselves can shape our financial world.
Ah, yes, the power of narratives. It's a really interesting aspect of financial psychology.
So like how we perceive risk, for example.
Exactly. The book argues that stories can heavily influence our perception of both risk and opportunity.
Can you give an example?
Sure. Remember the story we all bought into about housing prices always going up? That narrative was so strong, it led many people to make risky decisions.
And when that story fell apart, the whole economy took a hit.
Precisely. It's a reminder that our beliefs, the stories we tell ourselves, can become self-fulfilling prophecies.
So we need to be aware of those narratives, challenge our assumptions, and look at things from different angles.
You got it. And it's not just about the big stories like the housing market. It's also about the stories we tell ourselves about our own finances.
Our internal narratives.
Exactly. If we're constantly telling ourselves we're bad with money or that we'll never be rich, those beliefs can become self-fulfilling.
So we need to be mindful of that inner voice.
Absolutely. And remember, the book emphasizes that financial success isn't just about knowing the right formulas or strategies.
It's about understanding our own behavior
Yeah.
and how our psychology affects our decisions.
Precisely. It's about mastering our minds as much as we master our money.
So we've seen how our psychology shapes our financial choices. But what about the specific decisions we make? Like, how do we know if we're being truly objective or if we're letting our biases creep in?
That's where things get really interesting. The book delves into the world of behavioral economics. It's all about understanding the hidden biases that can trip us up.
Biases. Like what?
Well, there are a lot of them. The book talks about things like confirmation bias, anchoring bias, the availability heuristic.
Okay, slow down. Those are some big words. Can you explain them in plain English?
Sure. Confirmation bias is like our tendency to look for information that confirms what we already believe, even if it's wrong. It's like if you're convinced a certain stock is going to go up, you might only pay attention to the good news and ignore any warning signs.
Oh, I see. Like we see what we want to see.
Exactly. And then there's anchoring bias. That's our tendency to get stuck on the first piece of information we receive, even if it's not accurate. Imagine you're buying a car, and the salesperson starts by giving you a ridiculously high price.
That first price would probably stick in my mind, even if I knew it was too high.
Exactly. That's anchoring bias at work. And finally, there's the availability heuristic. That's our tendency to overestimate the likelihood of things that are easily remembered or widely publicized. Like, after a big stock market crash, we might be extra fearful of investing, even though statistically, those events are rare.
So our brains can really trick us sometimes.
They sure can. That's why it's so important to be aware of these biases and try to counteract them.
Okay, so how do we do that? How do we avoid falling victim to our own brains?
The book suggests a few strategies, like seek out diverse perspectives. Don't just listen to people who agree with you. Challenge your assumptions and be open to the possibility that you might be wrong.
So basically, stay humble and keep learning.
Exactly. And when it comes to making financial decisions, try to rely on data and evidence instead of just gut feelings.
Okay, so logic over emotions.
Well, it's not always that simple. Remember, the book emphasizes being reasonable rather than purely rational. We can't completely ignore our emotions.
So it's about finding that balance between logic and emotion,
Right.
right?
Precisely. And that leads to another important aspect of financial psychology, managing our emotions, especially when it comes to investing.
Oh yeah, the emotional roller coaster of the market. It's no secret that investing can be stressful.
It can be. You see your portfolio go up and you feel excited, maybe even a little greedy, but then it goes down and you start to panic.
In there.
It's natural to feel those emotions, but the key is to not let them control your decisions.
So what can we do to stay calm when the market gets crazy?
The book offers some great tips. First, focus on the long term. Remember that short-term fluctuations are normal. Second, understand that market downturns are inevitable. They're part of the cycle. And third, have a support system. Talk to a financial advisor, a friend, or a family member who can help you stay grounded.
Those are some solid tips. So basically, have a plan, stay disciplined, and don't panic.
Exactly. And remember, the psychology of money isn't just about how to get rich. It's about understanding our relationship with money and making choices that align with our values.
It's about using money as a tool to build a better life, not letting it control us.
Precisely. And that's a journey worth taking. It's about taking that journey with, open eyes and a curious mind. And the book also highlights how people who've already made it, financially speaking, they often think about risk differently.
Different how?
Well, they get it. They've seen how easily fortunes can disappear.
So they're not afraid of risk, but they're more cautious.
It's more like they respect risk. They factor it into their decisions. They know even the best plans can go wrong.
It makes me think of that saying, takes money to make money. Maybe they're more willing to take risks because they have more of a cushion.
That's a great point. They've got that margin of safety we were talking about. It's not all or nothing for them. And speaking of safety, the book talks about this big financial mistake people make. It's not getting the goalpost to stop moving.
Goalposts? I'm not sure I follow.
It's that human thing, always wanting more. Our income goes up, our expectations go up right with it, and we're never really satisfied.
Chasing that next level, never happy with what we've got. I get it.
Exactly. And the book is like, find a sense of enough. It's good for your wallet and it's good for your soul.
Easier said than done these days, with social media shoving everyone's perfect life in your face.
You're telling me the book talks about the dangers of comparing yourself to others. It's a recipe for misery.
It's so easy to fall into that trap. Even when you're doing okay, there's always someone with more.
And that's where it gets you. It's like comparison really does steal your joy.
So how do we stop playing that game?
Shift your focus. Look at your own progress. Celebrate your wins. Be grateful for what you've got.
Focus on your own lane, not what everyone else is doing.
Exactly. And, this kind of relates to the hedonic treadmill idea. Ever heard of that?
Rings a bell. What's that about again?
It's that thing where, we get more stuff, more money, but our expectations just keep going up.
So we never feel truly satisfied.
Right. You get a raise, but suddenly you need a fancier car, a bigger house. It never ends.
Sounds exhausting.
It is. The book says break free from that treadmill. Find joy in the simple things. Appreciate what you have.
So appreciate the journey, not just the destination.
You got it. The book uses this great analogy. It's like back in the 70s when there was that oil crisis. Instead of finding more oil, the U.S. just got better at using less energy.
So we can get better at managing what we have instead of always needing more.
Right on. Cut expenses, avoid that debt trap, live a bit more sustainably.
Sounds like a recipe for more freedom and control, which is what we all want, right?
You nailed it. And something else the book challenges is this idea that we always got to chase the highest returns on investments.
Really? Isn't that the whole point?
It's tempting, especially when you're starting out. You see these investments promising huge gains and you think, I got to get me some of that.
But there's always a catch, right?
You bet. High returns, high risks. If those risks bite you, well, ouch.
Not worth losing sleep over.
Exactly. Sometimes aiming for pretty good returns that you can sustain over time, it's the smarter move.
So play it safe, but still make your money work for you.
Right. The book uses this billionaire investor, Monish Pabrai, as an example.
I've heard that name. What's he known for?
Well, he's all about finding undervalued companies with low risk. So even if his investments don't go through the roof, He's unlikely to lose big.
Sounds pretty clever. Like protecting your money while still letting it grow.
Yep. He calls it his heads I win, tails I don't lose much strategy.
I like that. It's like having your cake and eating it too.
Yep.
But doesn't that kind of contradict the whole never bet everything idea?
Not really. It's about understanding that some risks are worth taking while others are just reckless.
Okay, so it's about calculated risks.
Exactly. And that connects to what the book calls the tails in investing.
Tails,
Mm.
as in the opposite of heads.
Sort of. It's
Yeah.
more about how tiny differences in returns can lead to huge differences in wealth over time. Like the book compares Warren Buffett to this hedge fund guy, Jim Simons.
Oh, I know that name. He's like a math genius or something, right?
That's the one. Turns out Simons has higher average returns than Buffett.
So he's the better investor.
Not necessarily. See, Buffett's been investing for way longer. So even with slightly lower returns, his total wealth is way bigger.
Wow. So time really is money.
Big time. And this all goes back to that idea of slow and steady wins the race. It's not about hitting home runs all the time. It's about consistent growth.
Consistency and patience, that's the key.
You got it. And speaking of staying the course, the book highlights this key trait of successful investors. They do the average thing when everyone else is freaking out.
Of like a superpower in the financial world.
It kind of is. It's about staying calm when the market's volatile. Don't panic sell. Don't chase those hot stocks that everyone's talking about.
Easier said than done when you see your hard-earned money shrinking.
It takes practice. But the key is to trust your plan and have faith in your long-term strategy.
So emotional intelligence is as important as financial knowledge.
Absolutely. Master your emotions. Avoid those impulsive moves driven by fear or greed. It's a game changer.
Okay, so we need to be cool-headed investors. What about our general outlook? Does it matter if we're more optimistic or pessimistic?
The book dives into that too. It's not as simple as saying one is good and one is bad.
So being a pessimist isn't always a bad thing.
Not when it comes to money. A little bit of pessimism can help you manage risk better. You acknowledge those potential downsides. Prepare for setbacks.
So a dose of reality is healthy.
Exactly. It's about being realistic, not letting your emotions cloud your judgment. The book talks about this guy, Jesse Livermore, a legendary trader back in the day.
What happened to him?
Well, he was brilliant, made a fortune in the roaring 20s, but his success made him overconfident.
He got cocky.
Big time. Started taking bigger and bigger risks until, well, it all came crashing down. Classic tale of pride before the fall.
Ouch. So even the best can fall victim to their own ego.
It's a reminder to stay humble, respect the power of risk.
So a little pessimism keeps us grounded. But what about the flip side? What's so seductive about pessimism?
It's like our brains are wired for it. Bad news grabs our attention. It's a survival thing.
Makes sense. But doesn't that make us overly cautious?
It can. We might miss opportunities because we're too focused on what could go wrong. Remember that Russian professor who predicted the U.S. economy was going to collapse?
Vaguely. Did it happen?
Nope. But it sure scared some people. It's a reminder to be critical of the doom and gloom, not let fear-mongering control our financial decisions.
So stay informed, but don't be ruled by fear.
Right. And remember, history doesn't always repeat itself. Just because there's been a financial crisis in the past doesn't mean it's going to happen again.
Okay, so past performance is not indicative of future results, as they say.
Exactly. And the book reminds us that everyone has different goals, different timelines. It's like not everyone's playing the same game.
So what looks risky to one person might be perfectly reasonable to another.
Right. And if we're not careful, we can end up playing someone else's game, making decisions that don't make sense for us.
Like trying to run a marathon at a sprinter's pace.
Perfect analogy. Figure out your own game plan, your own pace.
Find your own rhythm. Makes sense.
The book uses the dot-com bubble as an example. Back then, some people were paying insane prices for internet stocks.
The dot-com boom, when everyone thought they were going to get rich quick.
Exactly. Those prices probably seemed crazy to, traditional investors who focus on, solid companies with real earnings.
But for those caught up in the hype, it probably felt like a once-in-a-lifetime opportunity.
That's the thing about markets. Emotions can drive prices way up or way down, sometimes out of touch with reality.
So be aware of the hype, but don't get swept up in it.
Exactly. Do your own research, trust your gut, and don't be afraid to walk away if something feels off.
Sounds like a good rule of thumb for life in general.
It's like we can't just read about this stuff and think we're good. We got to actually put it into practice.
So it's like a workout, but for our minds.
Exactly. Financial fitness, right. You gotta train your brain just like you train your body.
Makes sense. And speaking of staying strong, the book has some good advice on dealing with the emotional side of, like, the whole money thing.
Oh, yeah, investing especially. It's a roller coaster, that's for sure.
One minute you're up, the next you're down. Makes you want to scream sometimes.
It's natural to feel those ups and downs, excitement, greed, fear, all of it.
The book says it's important to, like, manage those feelings, right?
Mhm.
Not let them make you do something stupid.
Exactly. You can't let your emotions drive your decisions, especially with investing.
So have a plan, stick to it, don't panic. Easier said than done, though.
It takes practice, for sure. The book gives some good tips, like first, zoom out. Focus on the long game, not those little daily ups and downs.
Don't get lost in the noise.
Right. Second, accept that the market's going to drop sometimes. It's normal, it's a part of the cycle.
So don't freak out when it happens.
Exactly. And third, have someone to talk to, a financial advisor, a friend, someone who can help you stay level-headed.
So find your financial support group.
You got it. And of course, it all comes back to having a solid plan in the first place. Something that fits your goals, your risk tolerance, all that.
Your own personal roadmap.
Exactly. And remember, as we've been talking about, that plan needs to be flexible. Life changes, your circumstances change. You got to be able to adapt.
Roll with the punches. Okay, so we've covered a lot of ground here. We've talked about how our psychology affects our money choices, the importance of being aware of our biases, and the need to stay grounded amidst all the craziness of the financial world.
It's been a great discussion. The psychology of money, it's a real eye-opener. It challenges you to think differently about money, about success, about what really matters.
It's not just about the numbers, it's about understanding yourself.
Exactly. And, as we wrap things up, I want to leave you with this final thought from the book. Financial independence, it's not just about having a fat bank account.
It's about having the freedom to live life on your own terms.
Exactly. It's about being able to pursue your passions, spend your time doing what you love, build a life that reflects who you truly are.
It's about using money as a tool to create the life you want, not letting it control you.
That's the real power of understanding the psychology of money. So keep learning, keep growing, and remember, it's not just about the destination, it's about the journey.
Great advice. Well, folks, that's a wrap on our deep dive into the psychology of money. We hope you've enjoyed the conversation and learned some valuable insights along the way. Remember, financial success isn't just about what you know, it's about how you behave. Take these principles to heart, reflect on your own relationship with money, and start building a brighter financial future for yourself.